There's a figure that almost no one charts, $200 a month. Below that point, compounding doesn't stop, but it works so slowly that for the first decade, your account balance is virtually indistinguishable from a regular savings account. Most financial calculators are designed to hide this fact. There's a second important metric that's never shown on charts: the precise moment when your investment returns begin to exceed your deposits. This phenomenon is called the transition point. There's a specific month when it occurs, and it happens to every investor. Now I'll demonstrate exactly how to find your transition point. No one explains compound interest this way. You've probably seen graphs that start with small amounts and skyrocket, turning into millions of dollars over a few decades. You may have applied these calculations to your situation and even opened an investment account. But a few years later, when you checked your balance, you might have felt disappointed. This feeling has a name: it's the first phase. Understanding its nuances could be the most valuable financial lesson you learn this year. Let's turn to specific figures, as uncertainty is useless. The S&P 500 index has averaged about 10% per annum over the past century. Adjusted for inflation, this figure approaches 7%. All calculations in this text use a conservative and realistic rate of 8%. This is not an idealized scenario for a pretty picture, but a pragmatic forecast. If you invest $50 a month at 8% annual interest, after a year of disciplined investing, your return will be approximately $5. After 10 years of regular contributions, your account will have approximately $9,200. Of this amount, almost $6,000 is the money you contributed personally. Less than $3,200 was the compounding effect over the entire decade. After 30 years of impeccable discipline, the amount will be $74,500. The Bureau of Labor Statistics reported that the average annual household expenditure in the United States in 2015 was approximately $40,000. Therefore, 30 years of your iron discipline will not cover even 2 years of average life expenses. This is not a problem of lack of will or effort, but a problem of entry threshold. Today I will show you exactly where this threshold is, what it takes to reach it, and why most people's instinctive reaction to this problem only makes things worse. The process of building wealth consists of two completely different stages. Almost all financial advice treats them as a single, continuous process, using the same logic and terminology for both. However, this is a mistake. These phases have different rules, priorities, and completely different impacts of returns on the final result. Once you begin to distinguish between them, the frustrating moments of your investment journey will make sense, and the truly important decisions will become clear. Think of compound interest the way a mechanic might think of a turbocharger. The turbine uses the energy from the engine's exhaust gases, essentially the waste product of the combustion process, to spin a wheel, which compresses the incoming air and forces it back into the cylinders to generate additional power. The waste product is converted into fuel, and the output energy becomes the input. The system amplifies itself. It's a classic feedback loop, where growth begets more growth. But turbochargers have a peculiarity: they don't work at low engine speeds. When the engine speed is low, the exhaust pressure isn't enough to spin the turbine. It's physically present in the system, but you don't feel it working. The engine operates solely through direct combustion of fuel. All power comes from what you feed it. Then, at a certain RPM threshold, the boost kicks in. Drivers call this the pickup moment. The power delivery completely changes. The engine produces significantly more than you'd expect from fuel injection alone. The feedback loop has activated. Your investment portfolio works the same way. Until your balance reaches a certain level, you are the engine. Your monthly payments are the combustion process. Profit is the exhaust gases, which technically return to the system, but their pressure isn't enough to make a significant difference in your financial life. The turbo is there, it's spinning, but until it reaches full power, you're driving it yourself, manually, every month. The threshold at which this boost kicks in, when compounding begins to yield more benefit than your contributions, is typically between $100,000 and $150,000 in total investable assets. Every dollar you contribute in the first stage is needed only to rev the engine to the point where the turbo kicks in. That's the whole point of the first phase. Any actions taken to accelerate this process, increasing income, cutting unnecessary expenses, redirecting salary increases, serve one goal: to make the accumulated capital large enough for the interest rate to matter. In the first stage, contributions are the strategy, and compound interest is the reward you'll receive later. Let's look at the math that's often hidden behind pretty graphs. All calculations are based on an 8% annual return, compounded monthly. The only variable is the monthly contribution amount. At $50 a month, after 10 years you'll have $9,200, after 20 years, $29,500, after 30 years, $74,500. At $200 a month, after 10 years, $36,800, after 20 years, $117,800, after 30 years, $298,000. If you contribute $400 monthly, after 10 years, $73,700, after 20 years, $235,600, after 30 years, $596,000. The interest rate and time frame remain constant, only the contribution amount changes. The final result over 30 years has grown from $74,500 to almost $600,000. But these figures conceal the most important indicator. With a contribution of $50, your portfolio will never cross the $100,000 mark, not in 20, not in 30 years. You will spend your entire investing life in the first phase. The turbine will never reach its desired speed. You will toil for 3 decades, never seeing any acceleration. With a contribution of $400, you will cross the $100,000 mark around the 14th year. After that, compounding will begin to significantly outpace your contributions. The second phase will begin, leaving you with another 16 years for powerful capital growth. The difference between these scenarios is the difference between a secure retirement and having to work part-time until your 70s. Andrew Hull, an English teacher from British Columbia, retired a millionaire on a typical teacher's salary. He wrote about his experience in his book, The Millionaire Teacher. People often see this story only as a lesson in frugality, old cars, home-cooked meals, cutting out luxuries. All of this is important, but many miss the main mechanism. Frugality wasn't an end in itself. It was a way to ensure a high enough monthly payment to overcome the first phase's threshold while there was still time for compounding in the second phase. In his own words, the last decade before retirement seemed almost effortless. The math took over. The engine was running on turbocharger. Before the turbocharger kicks in, you pack lunches. After it kicks in, those lunches no longer matter, as the system has acquired its own inertia. Social media usually shows the results of an 18th year of investing, and you compare your 40th month to that result and decide that your strategy is wrong. But the strategy is correct, you're just on a different part of the same journey. When people experience the disappointment of the first phase, checking their balance after several years of investing, they often make the wrong diagnosis. They think their returns are too low. They start looking for ways to improve them, although the real problem is their contribution rate. Let's prove it with numbers. $200 a month at 8% will turn into $36,800 over 10 years. Let's say you were able to double your return to 16% per annum. This is a figure that even the world's largest funds cannot achieve consistently. With such a fantastic return, after 10 years, you will have approximately $52,200. That's $15,400 more than at 8%. Sounds good until you understand the cost of such a return. You will have to deal with volatility, with a portfolio that can fall by 40 or 50% in bad years. Analysts show that the average investor often underperforms the market by 2 to 3 percentage points due to panic selling during declines. The theoretical 16% in reality turns into 8 or 9 due to human factors and emotional upheavals. Instead of chasing yield, imagine increasing your monthly contribution from $200 to $350, with the same boring 8% annual interest rate. After 10 years, you'll have approximately $64,000 in the same index fund. That's more money with less risk, no panic decisions, and no unnecessary fees. Increasing your contribution will always beat chasing yield as long as your balance is small. This isn't just a principle, it's arithmetic. Financial media rarely talk about this directly because it's impossible to make money from disciplined investments in a typical index fund. A brokerage account that's simply funded and doesn't make unnecessary trades generates no fees or management income. Complex strategies, active stock selection, and market timing, that's what can be monetized. Return is an interesting figure for headlines and debate. In the initial phase, it's almost irrelevant. The lever that changes your results isn't the market, but your deposits. Look at the monetary equivalent of 8% at different balance levels. 8% of $10,000 is $800 a year or $67 a month. It doesn't change your life, it's just a tank of gas. 8% of $100,000 is $8,000 a year or $667 a month. That's real passive income. 8% of $500,000 is $40,000 a year or $3,333 a month. That's financial independence. The interest rate is the same, but life is completely different. The only variable is the amount of accumulated capital. The first phase is the time it takes to build that capital. Interest is just noise until the amount is large enough for the results to become tangible. This is where fees become truly dangerous. An annual management fee of 1% with an 8% return leaves you with 7% net. Over 30 years, a $100,000 portfolio at 8% will grow to $1,060,000. At 7%, it will only grow to $761,000. The fee will cost you $245,000. This isn't just the amount of fees, it's the lost profit from compounding that money over 3 decades. The insidious thing is that this damage is imperceptible in the first phase. With an account of $16,000, the fee will only be $160 per year. The catastrophic scale of the loss will only become apparent in the second phase, when it's too late. The first phase fails not because the math stops working, but because it works too slowly. The investor's brain mistakenly perceives the lack of immediate results as evidence of a flawed strategy. Behavioral economists call this the feedback gap problem. People continue with actions that produce visible results and abandon those that seem ineffective. In the first phase, the return is so small that it is below the brain's threshold of perception. The brain says, "This isn't working." The correct conclusion should be, "This is working exactly as intended, but the scale is still too small." This gap between reality and perception is where the most costly mistakes are made. The most dangerous of these is changing your strategy. You correctly understand that a change is needed, but you misdiagnose. Instead of increasing your investments, you resort to speculation, buying individual stocks, or following dubious recommendations. Research shows that the most active traders often earn significantly less than the market due to trading costs and the habit of buying assets at their peaks. Inaction in the first phase is not passive failure, but a statistically optimal solution. The only problem is that it looks like waiting, and waiting looks like inaction. Consider Marcus. He's 38 years old, works in logistics, and earns $78,000 a year. 8 years ago, he started putting away $150 a month in a diversified fund. He's never missed a payment or panicked. He now has $16,500 in his account. His own investments total $14,400, and his profit over 8 years is only $2,100. Marcus is beginning to think that investing is only for the rich, whose large accounts allow interest to accumulate effectively. He considers risky deals in real estate or tech stocks. But Marcus isn't making any mistakes, his system is working perfectly. It's just that at $150, he's well below the turbo boost threshold and will remain there for decades. The solution for him isn't a new tool, but more fuel for the same engine. If Marcus continues to contribute $150, he'll have about $121,000 by age 65. That's not enough to retire on. If he increases his contribution to $400, less than half the average car payment in the United States, he'll have about $337,000 by age 65. That's 3 times as much for a less than threefold increase, since he'll cross the phase 1 threshold earlier. If he can contribute $600 a month, he'll have $537,000 by retirement. That's a decent standard of living. The difference between those two amounts isn't a matter of intelligence or secret knowledge, but of an extra $250 a month invested before it's consumed by his lifestyle. There are 3 levels of acceleration on the path to your goal. The first is adjusting your contributions. People often contribute less than they could, simply out of inertia. They set an amount when they opened their account and never updated it, even though their income grew. The process is simple: log into your account and increase your monthly payment by at least $50. Over 20 years, at 8% annual interest, this will add up to an additional $29,400. Set a reminder to review this amount every year on January 1st. The second level is redirecting income growth. When your salary increases or you receive a bonus, your lifestyle usually absorbs that money within 90 days. This happens automatically. A rule that really works: direct 50% of any increase in your net income directly into investments. Your standard of living will still increase due to the remaining half, but you'll significantly accelerate reaching your financial threshold. Speed is key. The longer the delay between receiving money and investing it, the more likely it is to be spent. The third level is using completed financial obligations. There are times in life when large regular expenses cease, the car loan is paid off, student loans are paid off, or children become financially independent. This creates a window of available funds. The average car payment is over $700 per month. When the loan is closed, this money is freed up. Most people don't make a conscious decision, and within 3 months, these funds are lost in everyday expenses. A wise investor increases contributions on the same day the last loan payment is made. Redirect at least half of this amount into assets, and keep the other half for increasing comfort. This is a question of system design, not willpower. The most important years of a 30-year journey aren't the last 5, even though that's when you see the biggest growth. The most important are the first 5 years. $1 invested in the first month at 8% annual interest will turn into about $10.60 after 30 years. The same dollar invested in the 25th year will turn into only $1.47. Your first investments are more than 7 times more effective than later investments due to their longevity. This means that every month of delay or every year of slow investment deprives you of the most valuable dollars in your portfolio. The advice to start small doesn't mean you have to stay there forever. It's just a way to get started. Increase your investment as soon as possible, because it's the early dollars that have the greatest growth potential. Treating investment contributions as optional, residual expenses is the most expensive financial habit. Marcus has already increased his contribution to $400. In 8 months, he'll pay off his car loan and has already decided to put some of that money into an account. He won't notice the difference right away, but in about 10 years, when his balance exceeds $100,000, his statements will change. His profit line will begin to compete with his contribution line. The turbocharger will kick in, and he'll have another 17 years of strong growth before he decides whether he wants to continue working. Here are 3 specific steps to take. First, calculate your contribution to return ratio. If contributions account for more than 70% of your monthly account growth, you're in phase 1. Your primary goal is to grow your contribution, not find the best funds. Second, determine your target date. Find the year when your portfolio will cross the $100,000 mark at your current rate. Consider what contribution would allow you to reach this goal 2 years earlier. Third, decide in advance on your next financial event. When you receive a bonus or pay off debt, how much exactly will you invest? Make this choice now, before the money is in hand. A decision made in the abstract is much easier to execute than one made when the cash is already burning a hole in your pocket. Lazy investing has created more fortunes than any speculation. Successful investors simply recognized what phase they were in, revved up their engines, pushed through the threshold, and let the math do its work.